Last week, something happened that most investors completely missed. And I'm not talking about an earnings report or an AI announcement, and not another NVIDIA headline. The NASDAQ made a decision, and that decision effectively created a mandatory buyer with more than $800 billion behind it. The company is CoreWeave. The ticker is CRWV. So just over a year ago, CoreWeave went public at $40 a share, and today it is up more than 150%. And now it's being added to the NASDAQ 100, which means it's going into the QQQ. Now, if you're new to how index investing works, here is the important part. Every ETF and passive fund tracking the NASDAQ 100 must now own CoreWeave before June 22nd. Not because they suddenly love the company, and not because they think it's undervalued, but because they are required to. That's what makes this story interesting. You have one of the hottest AI infrastructure stocks in the market colliding with a wave of mechanical buying pressure that could exceed $1 billion. But that's only half the story, guys, because at the exact same time this is happening, another headline is making rounds. QQQ holders get CoreWeave debt. So today we're going to break down both sides. Why institutions are being forced to buy, and why CoreWeave matters, and what the debt concerns on this company actually are, and how I think about the option setup heading into June 22nd. So guys, this is Luke with the OptionBomb, and we are going to take a look right now and talk about what just happened. So the event itself. Last week, the NASDAQ announced that CoreWeave would join the NASDAQ 100 effective June 22nd. And immediately the stock jumped about 5% after hours. That reaction wasn't about fundamentals. It was about mechanics. Because the NASDAQ 100 isn't just an index. It is one of the most heavily tracked indexes in the world. More than 200 investment products globally track it. Combined assets under management exceed $800 billion. And QQQ alone manages over $300 billion. Once a company gets added, every one of those products has the same job. Buy the stock, build the position, match the index, no opinions, no analysis, no discretion, just buy it. So from June 12th through June 21st, funds began accumulating shares. Some buy in early, and some wait until the last possible moment. Others use trading desks to spread purchases across multiple sessions. But by the morning of June 22nd, they all need to be fully positioned. That's why investors call it forced buying, because that's exactly what it is. And even though CoreWeave's weighting inside the index will likely be relatively small, we're still talking about meaningful money. At a 0.2 to even a 0.3% weight across $800 billion in the ecosystem, that translates into well over $1 billion of demand. And that's real. And that's why Wall Street is paying attention. So now let's quick talk about the company, because CoreWeave isn't just some random stock getting added to an index. CoreWeave sits directly in the middle of the AI infrastructure buildout. They're a GPU cloud provider. So in simple terms, they rent massive amounts of NVIDIA computing power to companies building artificial intelligence models. They're not creating ChatGPT, and they're not building the AI. They are selling the infrastructure the AI runs on. So think of them as the picks and shovels provider during a gold rush. And the customer list is impressive. We're talking Meta, OpenAI, Anthropic, Mistral, Cohere, essentially a who's who of artificial intelligence. But then there's NVIDIA. Earlier this year, NVIDIA made a $2 billion private placement investment into CoreWeave at $87.20 per share. That's not a small partnership. That's NVIDIA directly putting capital behind the company. Now, some have looked at this investment and said, oh, NVIDIA is just giving them money so they can buy more NVIDIA chips. We've all seen that circular reference thing floating around on X. Okay, but we are going to ignore that for a while and assume the investment was real. Okay, and the growth numbers behind this, guys, explain why. Revenue in 2025 reached $5.1 billion, up 170% year over year. Q1 2026 revenue came in at $2.08 billion, up another 111%. Management is guiding for between 12 and 13 billion in revenue this year. And perhaps most importantly, the backlog stands at 99.4 billion. That's contracted future business already on the books. Included in that figure is also a $21 billion commitment from Meta alone. Then 2 weeks ago, CoreWeave became the first company to validate NVIDIA's new Vera Rubin NVL72 platform. The stock immediately jumped another 14%. So from a growth perspective, the story's real. But this is where things get interesting, because most index additions happen years after a company becomes public. The market already understands the business. Institutions already own it. The index inclusion is just a technical event. CoreWeave is different though. The company IPO'd in March 2025. It's only been public a little over a year. And many institutional investors are still building positions. Large money managers don't typically deploy billions overnight. They scale in. They build exposure over quarters and sometimes years. So now think about what's happening. Active managers are still building positions because of the AI growth story. And at the exact same time, passive managers are being forced to buy because of the index inclusion. That's two separate demand engines operating simultaneously. And unlike many inclusion trades, there's a legitimate fundamental argument behind the demand. You have 111% revenue growth, nearly a $100 billion backlog, Meta and OpenAI contracts, NVIDIA backing, leadership in AI infrastructure. That's why it's not just a technical trade. The fundamentals are helping support the narrative. But now we have to talk about the headline everybody is debating, which is QQQ holders get CoreWeave debt. Because there is a real concern here. CoreWeave's business is incredibly capital intensive. To build AI infrastructure, they have to purchase enormous amounts of NVIDIA hardware up front, and that costs billions of dollars. The revenue will come in later, over probably several years, through long-term contracts. So to finance that expansion, the company has taken on substantial debt. Interest expense doubled year over year during 2025. The company remains unprofitable on a GAAP basis, and that's not some minor accounting detail. The entire bull thesis depends on several things continuing to work. The backlog has to convert into revenue. The customers need to keep spending. AI demand needs to remain strong, and the contracts need to hold. And management needs to service the debt while continuing to expand. That's a lot of moving parts. Then there's another data point investors should know. This week, CoreWeave's chief strategy officer sold approximately $7.45 million worth of stock. Now, that doesn't automatically mean anything negative. Executives sell stock all the time. Taxes, diversification, liquidity. Those are all normal reasons. But when a stock is up dramatically and entering a major index, it's information worth knowing. Not because it's a red flag, but because it's part of the complete picture. So let's talk options on this, guys. And to be perfectly clear, I'm not going to be trading this one, but we can talk a little bit about the setup. Because this is where many traders get themselves into trouble. When a stock like CoreWeave approaches a major event, implied volatility tends to rise. The market knows something important is happening, and the uncertainty gets priced into the options. It's just how it works. That means options become more expensive. So if you're buying calls today, understand you're not just betting on direction. You are paying for elevated volatility. The market already expects movement, and then comes the second risk, the volatility cliff. Once June 22nd arrives and the inclusion is complete, the uncertainty will disappear and the event will be over. And implied volatility frequently, you can't say with 100% certainty, but in situations like this, it frequently compresses. And this is how traders can be right on direction and still lose money. The stock can go up if you bought a call, but volatility falls enough to offset your gains. And that's why expiration selection matters. Generally speaking, we want enough time after June 22nd for this thesis to continue playing out, not expirations that die immediately after the event. And that's also why defined risk structures could become attractive. Call spreads limit upside, but they also reduce exposure to elevated premium. So with CoreWeave already up more than 150% from its IPO price, many traders find that the risk profile more attractive than simply buying naked calls. There's no universally correct answer here though, but the question is simple. How much movement are you paying for? And how much movement do you actually expect? So guys, the reason I wanted to make this video isn't just CoreWeave. It's because this setup is going to happen again and again. Anytime we see a recent IPO, explosive growth, institutional adoption, rapid market cap expansion, and major index exclusion, you should immediately start asking the same questions. How long has it been public? Are institutions still building positions? What's the debt profile? Are insiders selling? What's the implied volatility doing, and how large is the index weighting? Because all those variables affect the trade. And CoreWeave checks almost every box. AI infrastructure with hypergrowth, NVIDIA backing, massive backlog, heavy debt, fresh IPO, and now over 800 billion in passive assets being forced to buy. That's why Wall Street is watching it. So here's the takeaway. CoreWeave joining the NASDAQ 100 creates a real demand catalyst. Hundreds of billions of dollars track that index. And every passive vehicle must own the stock before June 22nd. That's not speculation. That is mechanics of the stock market. But CoreWeave's debt is real, and the insider selling is real. And once the forced buying ends, the stock has to stand on its own fundamentals. That's the difference between understanding the trade and simply chasing momentum. If you'd like a dedicated option change breakdown, guys, before the effective date, let me know down in the comments and we'll throw something together for you. And make sure you hit like and subscribe, because I'll also be covering the other NASDAQ 100 additions that got called out this week, including Nebius Group and Rocket Lab. Guys, this is Luke with the OptionBomb. Thanks for watching, and I'll see you in the next one.